In this video, I will be explaining why I'm buying this public transport stock, which is down over 75% since the most recent high. And trust me, there is a very good reason for buying this company. To illustrate, the CEO of this company has the most sexy accent I've personally heard in a CEO in quite some time. Oh, and the stock gives investors a 25% plus free cash flow yield at this moment in time, or something similar like that. But before that, real quickly, welcome to another episode in my Value Investing Model Portfolio series, where I'm investing real money with the purpose of building up a track record over time. Today is the 14th episode, and let's get right into it with first, National Express Explained. So why did I buy this boring public transport stock? After all, if you would purchase this stock back in the year 2000, you would still be down more than 80%. And then if you purchase the stock again in the year 2007, you would still be down more than 80%. And then again, more recently, if you purchase stock around 2019, 2020, you would still be down more than 75%. Why would anyone touch a stock with such a bad track record, even with a 10-feet pole? This company is the stock equivalent of Tiffany behind the dumpsters at Wendy's. No one wants her services, even for free. And especially which degenerate gambler would make National Express a 12% position in their portfolio. Why would anyone ever do that? Well, fair point, man. But to explain my reasoning, we first have to do two things. One, we have to decouple the share price action from the company. After all, they are two entirely separate things. And we value investors only care about the intrinsic value of a company. And of course, astrology, we care about astrology. Two, we have to analyze that business. Is it any good? Would we like to own it? And when we analyze the business that is National Express, in my opinion, it is definitely something we want to own. So if we just go through the financial statements one by one, this by the way is the comprehensive income statement, then we see for the full year 2022 that the company is losing money at about 84 million British pounds a year. That of course isn't a great thing, but is the company actually losing money or just on paper? Well, more on that in just a bit. I would have liked it if the intangible asset position was a bit smaller, because if you look at the notes, intangible assets only include goodwill, and goodwill in my opinion has even less value than Tiffany's services. The current asset position is quite healthy, meaning the company has enough liquidity to continue operations for quite some time. And if we look at the debt, the borrowings, it is not too much. Now the true banger, the cash flow statements, and this tells us quite a bit about the true profitability of National Express. So from operating activities, the company is raking about 220 million British pounds a year, which is a shit ton of money compared to the current market cap of the company. Then if we look at investing activities, the company is spending about $180 million per year at this moment in time, and that money is spent on mainly the purchases of property, plant and equipment at about $169 million. I see nothing wrong with this. And then in financing activities, the company is again spending about 200 million British pounds a year, mainly on paying back loans and paying a dividend, but also payments to settle foreign exchange forward contracts or hedging. Again, nothing wrong with this in my opinion. So if we take everything into account, the company achieved a free cash flow of about 160 million British pounds in the year 2022, which results in about 25 cents in free cash flow per share if an investor buys today. Now, if you don't know what free cash flow actually is, that is completely fine. I'll just reference you to the Investopedia page because they give a pretty solid explanation. Please let me know if you want me to do a deeper explanation into why we value investors care so much about free cash flow. To get back to the point of this video, if an investor buys National Express today, they are getting a free cash flow yield per share of roughly 22%. That is phenomenally high. By the way, this is the track record of the company's free cash flows since the year 2015, if you are interested. So that is the main reason behind buying National Express, really. The company is giving investors an insane return on a free cash flow basis. I've done this quick and dirty calculation back when the share price of the company was still 110 British pound cents. We were getting roughly a 25% yield in free cash flows. Then we can add a 6% expected growth rate in free cash flow per share between now and 2027, based on management guidance by the way. And then we add a 14% per year return stemming from a revaluation on the stock market from a free cash flow multiple of currently 4 to 8 in the future. And all of a sudden, with all those growth rates, we are looking at a 45% compounded return for an investor between now and 2027. So that is why we bought National Express in such a large fashion. Again, roughly 12% of the portfolio at this moment in time. Now, 3 more things I need to share with you all. 1, these were all the transactions between the last video and this one. Enjoy analyzing them for yourself if you so desire. 2, this is how the portfolio currently looks, with names we have discussed extensively in past videos in this model portfolio series. So I would highly recommend checking out this playlist linked in the top right corner for each individual holding. And with that, that just leaves number 3, the comparison. And boy, we are winning again on the stock market. We're overperforming the S&P 500 with about 5.5% and we're overperforming cash with about 10.5% at this moment in time. By the way, this just means that since the start of this portfolio back in December 2022, we have achieved a 10.5% return on our investment. And a dollar cost average into the S&P 500 would have resulted in about a 5% return, so that means that we are overperforming with roughly 5.5%. Personally, I could not be happier with this resurgence to overperformance. After all, just last update, we were underperforming against the S&P 500 with about 4%. And of course, the biggest driver for those returns in the current portfolio are Bank OZK at about 730 euros of profit, and of course, Gannett at about 400 euros of profits. But also, our largest position in Clearfield is significantly less red than it was just 2 weeks ago, so that definitely helps. And that is about all I have for you guys today. Hopefully you enjoyed this quick update on my model portfolio series. Now, time for a classic YouTuber disclaimer. While I am a registered financial advisor in the Netherlands, I do not have the legal capacity yet to give anyone investment advice. Therefore, this video and any other video on this YouTube channel can never be taken as financial advice. I cannot be held liable for the losses you make while trading according to my opinions. Please do your own due diligence. And with that said, thank you so much for watching. I love you all. Peace.